If you were flying out of JFK, say, 10 or 15 years ago, you knew exactly who the cool kid on the tarmac
Oh,
was.
absolutely. It was JetBlue.
It was JetBlue. They had the blue chips. They had live TV when, nobody else did. They just had this vibe that felt human.
Yeah.
But if you've flown them recently, or if you've been watching the industry, you know that cool kid vibe has just, well, it's hit a wall of very adult problems.
It's the classic coming-of-age crisis, but, for an airline. And today, the stakes just could not be higher.
Exactly. It is Wednesday, January 28th, 2026.
Huh.
We have the Q4 2025 earnings report, hot off the press, and honestly, it is a fascinating document.
It really is.
On the surface, you see a revenue beat.
Yeah.
You see premium demand surging.
Yeah.
But then you look at the bottom line.
And there's the earnings miss.
There it is.
Yeah.
You see these stubborn costs, and you see an airline that is, fundamentally rewriting its own DNA.
We aren't just talking about a new paint job or, a new snack in the back. We are standing at a critical juncture for New York's hometown airline. For 25 years, they were the disruptor. They were the low-cost carrier, the LCC. Now, they are, for all intents and purposes, lighting that business model on fire to build something new.
So today, that's what we're doing. We are going deep on JetForward. This is the big initiative management claims will generate nearly $1 billion in extra profit by 2027.
A huge number.
We're going to tear apart the Blue Sky Alliance with United Airlines, which is just a strategic curveball I don't think anyone saw coming.
Nobody.
And we are going to look at the hardware changes. I'm talking about the metal, the seats, specifically the launch of a true domestic first class.
Which I have to say is a sentence that would have been considered complete heresy at JetBlue headquarters 5 years ago.
Right. So the mission for this deep dive, for you, is to help answer one question. Is this the evolution of a smarter, more mature airline?
Wow.
Or were we watching a desperate pivot by a carrier that is just getting crushed in the middle?
Squeezed between the Spirit Airlines of the world and the Supermajors like Delta and United.
That's the existential question, isn't it? Can you survive in the middle?
It's the hardest place to be.
Let's get into the evidence. So we have combed through the Q4 earnings transcripts from CEO Joanna Garrity and CFO Ursula Hurley. We've looked at the press releases on the new European routes, and we've really dissected the internal strategy decks.
The slide decks.
Regarding fleet modernization and this subsidiary called Paisley.
And I'm so glad you mentioned Paisley early because while everyone is looking at the planes and the new seats, the real story, the real alpha, might actually be in the software.
We are definitely going to spend some serious time on Paisley later on. But I think we have to start with the identity crisis.
We have to.
Because if you read these strategy decks, the message is crystal clear.
Mm.
The low-cost carrier model is dead. Long live the premium hybrid.
It's a massive shift. Historically, the industry really had two lanes, right? You had the legacy carriers, United, Delta, American.
Some guys.
The big guys. They had the first-class cabins, the lounges, the global networks. They were expensive, sure, but they were comprehensive. Then you had the LCCs, Southwest, JetBlue, one class of service, point-to-point flying, lower fares. Simple.
And JetBlue was always kind of the king of the LCCs because they offered a better experience within that model. The legroom, the TVs.
A better mousetrap, exactly. But now they are explicitly abandoning that. They are pivoting to what they're calling a premium-focused hybrid model. So my question to you is this safe?
That's the question.
JetBlue built its entire brand on being the egalitarian airline. Humanity, remember that campaign?
I do.
If they pivot to chasing the guy in the suit with the Amex Platinum card, aren't they just becoming a smaller blue version of Delta? Do they risk alienating the loyal fan base that actually likes them for who they were?
That is the billion-dollar risk right there. You risk alienating your core to chase a customer who is already loyal to someone else. But you have to look at the data in the Q4 2025 report. It's like it forced their hand. There is a divergence in the numbers that you just cannot ignore. Premium RSM, that's revenue per available seat mile, was 13 points higher than core RASM.
13 points. Can we just pause on that for a second?
Yeah, let's just sit with that. 13 points.
It's a chasm. It's not a gap. It's a canyon. What that number tells you is that the demand for core economy seats is soft. It's incredibly price sensitive. It's a race to the bottom against Spirit and Frontier.
A race JetBlue can't win and doesn't want to win.
Exactly. But the demand for premium, it's resilient. Even with the macro softness we've seen, people are willing to pay for space and a better experience.
So the strategy deck basically argues that if they don't offer a premium product, they aren't just losing the CEO on a business trip, they're losing the family of four going to Disney who decided, you know what, let's treat ourselves this year.
Precisely. They call it the full spectrum strategy. They realized they were flying the customer to the destination, to Orlando, but losing the high-yield booking to Delta because Delta had a first-class seat. If you are a business traveler, you often cannot book a flight that doesn't have a premium cabin. It's against corporate policy, or it's just a personal preference you're not willing to give up. JetBlue was effectively locking themselves out of the most profitable segment of the market.
Which brings us to the hardware. Because you can't just put up a slide that says, we are premium, and then stick everyone in the same 3x3 seat. You have to physically change the metal.
You have to build it.
And the big news, launching late this year, 2026, is domestic first class.
This is such a radical departure for them. We are talking about a proper 2x2 seating configuration. This isn't even more space with a blocked middle seat, which, is what you see in European business class.
Right, the glorified economy seat.
This isn't that. These are wide recliner seats. It is a true domestic first product.
And this is going on the non-Mint aircraft. So we're talking about the A321s that are doing the shorter hops, Florida, the Caribbean, maybe some of the shorter mid-con routes.
Correct. And the target is very, very specific. They want to capture those high-yield bookings that are currently just being ceded to Delta and United. Think about a route like New York to Nassau or Boston to Aruba.
Yeah.
There is a lot of money on those planes. Historically, the wealthy traveler would look at JetBlue, see only a coach seat, sigh, and then go book on Delta. Now, JetBlue has a product to sell them.
The rollout is pretty aggressive, too. I was looking at the deck. They're saying about 20% of the fleet will be retrofitted by the end of 2026.
And then completion in 2027. They're not messing around.
They're moving fast. But I want to ask about the Mint expansion as well.
Yeah.
Because Mint is their lie flat product. And it's arguably the best business class seat in the domestic market.
It's fantastic.
And they're putting this on premium leisure routes now.
Yes, places you might not expect, like Fort Lauderdale to Las Vegas or Fort Lauderdale to Phoenix.
See, that's what I find so interesting. Usually you think of lie flat seats for the really long-haul stuff, New York to London or LA to New York, the banker route.
The banker routes, yeah.
But Fort Lauderdale to Vegas, that's a party route.
It is, but it's a high-spending party route. People going to Vegas from South Florida have money to burn. Why shouldn't they start burning it on the slate there?
Oh, that's a good point.
It's about matching the product to the customer's wallet, not just the distance of the flight. If the demand is there, why would you force those people to sit upright for 5 hours if they're willing to pay not to?
That makes a lot of sense when you put it that way. Okay, now, let's look at the other end of the plane. Because even more is evolving.
Yeah.
It used to just be extra legroom. That was the pitch. But according to the slide deck, it's becoming more of a standalone cabin product. And the key differentiator here, it seemed to be, dedicated overhead bin space.
That is huge. I cannot overstate how huge that is. In the era of carry-on anxiety,
Oh, it's real.
guaranteeing bin space is a premium product in and of itself. How many times have you stood at the gate, you're in group 4, just stressing about whether you'll have to gate check your bag?
Every single time.
JetBlue is monetizing that anxiety. You buy even more, you get the bin. Period. End of story. It's a simple, brilliant upgrade.
And even the folks in the way back, the core experience, they're seeing some changes. They introduced preferred seating near the front for a fee. But here is the one that really caught my eye because it goes against the grain of every other airline right now.
Let me guess. The bag policy.
The bag policy. Blue Basic, their absolute cheapest fare, now includes a free carry-on bag.
It's a fascinating countermove, isn't it? While Spirit and Frontier, and hey, even the legacy carriers in basic economy are charging you for breathing the air and looking at the overhead bin,
Right.
JetBlue is zigging where everyone else is zagging.
It feels like a statement. It feels like they are planting a flag and saying, we are not Spirit. Stop comparing us to Spirit.
That is exactly the psychological play. They are trying to break the mental association with the ultra-low-cost carriers, the ULCCs. They are positioning themselves as the premium LCC, or maybe just not an LCC at all anymore.
But baseline is better.
Yes. Even the cheapest ticket isn't punitive. It's a clever way to justify a slightly higher fare floor by offering a more humane baseline experience.
Okay, so we've got the seats, we've got the bins, we've got the bag policy, but we can't talk premium without talking lounges. This was always the Achilles heel for them.
Always the big missing piece.
If I had a Platinum Amex or I was a top-tier frequent flyer, I'd probably avoid JetBlue because I had nowhere to work or relax before the flight. I'd be sitting at the gate eating a stale pretzel while my friend flying Delta was, sipping champagne in the Sky Club.
And that matters. It really matters for retention. It matters for getting that share of wallet.
Yep.
So they finally did it. They opened the first Blue House Lounge at JFK Terminal 5 late last year.
And the numbers. How's it doing?
The numbers are frankly staggering. They are hitting a net promoter score, an NPS, in the mid-80s.
Whoa. Hold on. For an airport lounge.
For an airport lounge.
Most airlines would kill for an NPS in the 50s. Mid-80s is. That's like Apple Store territory. That is unheard of.
It suggests the product is resonating very, very deeply. And it's not just about, free beer and some cheese cubes. It's about the design, the exclusivity. It's prioritized for Mint customers and top-tier Mosaic members. And the fact that it finally puts them on par with the competition.
A place to go.
A place to go. And they're opening a second one in Boston later this year. This is the final piece of the puzzle. You cannot seriously compete for the high-yield business traveler if you ask them to sit at gate B27 for an hour. You just can't.
So they have the seats, they have the lounge, they have the bag policy. That's the hardware of the pivot. But now let's look at the software, the grand strategy, because this brings us to the Blue Sky Alliance.
This is, from a strategic perspective, the most significant move JetBlue has made since they launched Mint. And it is also by far the most surprising.
We have to be crystal clear here, because the airline industry loves a good merger. This is not a merger.
Correct. And we have to stress that because of the history. The Spirit merger was blocked by the courts. Before that, the Northeast Alliance, the NEA with American, was also blocked. The Department of Justice, the DOJ, has made it very clear that full-blown consolidation is off the table for now.
So JetBlue was in a tough spot. They needed scale, but they couldn't buy it. Enter Blue Sky.
It's a collaboration with United Airlines. But your next question should be, how is this legally different from the NEA that got struck down?
That is my next question.
It's all in the regulatory design. The architects of this deal, you can tell, they took the judge's ruling on the NEA and used it like a blueprint of what not to do.
Oh.
In the NEA, there was revenue sharing on certain routes. There was schedule coordination. That, to the DOJ, smelled like price fixing. In Blue Sky, there is zero revenue sharing. There is no price coordination. There is no schedule coordination.
So help the listener visualize this. In a joint venture, like what Delta has with Virgin Atlantic, they basically put all the money from those transatlantic flights into one big pot and split it. They're married.
Correct. They share the bank account. They plan their holidays together. They're a single economic unit.
But Blue Sky isn't a marriage. It's what? Is it dating?
It's barely even dating. Think of it more like a referral program on steroids. If I, JetBlue, send a customer to your store, United, you pay me a small commission. If you send one to my store, I pay you.
So we're not setting prices together.
We don't set prices together. We don't tell each other when to open the shop, but we agree to hold the door open for each other's customers. It's designed specifically to bypass the antitrust scrutiny because the argument is we aren't colluding, we're just cross-selling.
Okay, let's unpack the loyalty play then, because this is huge for anyone out there with a stash of points.
It solves JetBlue's biggest weakness overnight. JetBlue's points, TrueBlue points, were always pretty valuable, but they were hard to use globally.
Right, they had a geographic limit.
Exactly. If you wanted to go to Tokyo or Frankfurt or Sydney, JetBlue couldn't take you there. Your points were stuck in the Americas and a bit of Europe. United, on the other hand, has a massive global network.
So now, with reciprocal earning and redemption, which launched late 2025, I can use my pile of JetBlue points to fly United to Tokyo.
Yes, you can. And conversely, United has millions and millions of Mileage Plus members. Now, they can use their miles to fly JetBlue to places United doesn't serve well, like Nantucket or Martha's Vineyard or some of the smaller Caribbean islands. It makes the TrueBlue currency significantly more valuable because it now has global utility.
And coming in Q1 2026, so any day now, basically, is interline selling.
This is the sales funnel. This is huge. You will be able to buy a JetBlue flight directly on United.com and a United flight on JetBlue.com.
So it's not just about points, it's about cash tickets.
Cash tickets. Think about the amount of traffic United.com gets. It's one of the biggest travel websites in the world. Millions of eyeballs a day. Suddenly, JetBlue inventory is visible to that massive customer base. It opens up a sales channel that JetBlue could never, ever build on its own.
That's a lot of eyeballs. But here is where it gets really, really interesting for me. And this is the part that I think people are sleeping on. The Paisley component.
Ah, yes. Paisley. This is the hidden gem in the whole deal.
Can we just pause and explain what Paisley even is? Because it sounds like a pattern on a tie or maybe a spice you'd put in a curry,
Yeah.
but it's actually their secret weapon.
It is. Paisley is JetBlue's subsidiary for non-air travel. It's a tech platform that sells hotels, car rentals, cruises, travel insurance, activities, you name it.
Ugh.
And it's asset light. This is the key. They don't own the hotels or the rental cars. They just built the software, the technology to book them. And because it's just software, the margins are, well, they're incredible.
That's incredible.
We are talking EBIT margins that are climbing into the 60s, 60%.
60% margins in the airline industry where you're lucky to get 6.
Well, that's the trick, isn't it? It's not the airline industry, it's the travel tech industry that happens to be attached to an airline. It's Expedia margins, not airline margins.
And here is the kicker, the absolute mind-blowing part of the deal. Starting in Q2 2026, Paisley is going to power United Airlines' non-air ancillary bookings.
This is the part of the announcement that made me do a double take.
I want to drill down on this. In the announcement, United CEO Scott Kirby basically admitted that JetBlue built a better mousetrap.
He did.
My question is, how? United has billions of dollars. They have armies of developers in Chicago and Houston. How is it possible that JetBlue, a fraction of the size, built a hotel booking engine that United couldn't match? Why would a giant like United outsource this critical function?
It comes down to two things, I think. Focus and legacy tech debt. United's backend is a Frankenstein's monster of decades of mergers. You have Continental systems glued to old United systems. It is notoriously difficult and slow to innovate on top of that kind of tech stack.
Spaghetti code.
The ultimate spaghetti code. Paisley, on the other hand, was built from scratch very recently as a dedicated modern tech stack. It uses modern APIs that can integrate hotel or car rental inventory faster and cleaner. It offers a better user experience, a better UX, which leads to higher conversion rates, more people who look actually book.
So it's the difference between trying to run a modern app on a Windows 95 computer versus running it on a brand new iPhone.
That's a perfect analogy. United looked at the numbers, and in a moment of real corporate honesty, they realized, we are bad at selling hotels. JetBlue is good at it. If we let them run our back end, even if we have to split the profit, we will make more money than if we keep trying to do it ourselves.
That is wild. It effectively turns JetBlue into a B2B tech vendor for United.
It does. It monetizes the travel journey beyond the flight. And since Paisley is capital light, it's just IT spend, there's no fuel, no planes, no flight attendants. It's pure high-margin profit expansion. It's a brilliant way to diversify their revenue streams away from the volatile airline business.
And there's a real estate component to this deal too, right? At JFK.
Yes, a smaller but still important piece. United gets access to JetBlue's new Terminal 6 at JFK, starting as early as 2027. United has historically been landlocked at Newark. They've had a very poor presence at JFK for years.
This solves that problem for them.
It solves a huge strategic problem for them. So you see, both sides get something they desperately needed. JetBlue gets global scale for its loyalty program and a massive new customer base for Paisley. United gets better tech, better monetization of their customers, and a real foothold at JFK.
It's a classic, you scratch my back, I scratch yours situation. But okay, let's shift gears because strategy is just words on a slide until you look at the bank account. We need to talk about Section 3, JetForward, the financial road to recovery.
And it is a very steep road, let's be honest about that.
Let's start with the scorecard. They have this big initiative, JetForward, and it's targeting $850 million to $950 million in incremental EBIT by 2027. First off, for the non-finance listeners, let's just quickly define incremental EBIT.
Sure. It stands for earnings before interest and taxes. It's a good measure of a company's core profitability. Incremental just means extra profit on top of what they would have normally made without these changes.
So they're looking for nearly $1 billion of new profit generated specifically by these initiatives, the new fees, the cost cuts, the new cabins.
That's the goal.
Okay. So how are they doing so far?
Well, 2025 was what they called the foundational year, and the results were actually very strong. They targeted $200 million in benefits. They delivered $305 million.
Wow, so they smashed the target.
They did. They beat it by over 50%. And that's important because it gives the market, it gives investors some confidence that this isn't just, vaporware or wishful thinking on a PowerPoint.
They can execute.
They can execute. For 2026, the outlook is to add another $310 million in contribution. If they hit that, it would bring the total cumulative benefit to $615 million by the end of this year.
And what about the margin targets?
They are expecting to hit break even or better on operating margins in 2026. Now, that might sound unexciting. Yay, we broke even. But you have to consider where they came from. They've been losing money.
It's about the trajectory.
It's all about the trajectory. This implies about 4 points of year-over-year margin improvement. Turning a massive capital-intensive ship around takes time, and getting back to break even is the critical first step before you can even think about real profitability.
Okay, but we have to talk about the elephant in the room. Or maybe it's the hippopotamus in the room. The debt.
The balance sheet. This is the bear argument. It is the reason some investors are still terrified of this stock.
And rightly so.
JetBlue is carrying very, very heavy baggage. Gross debt is sitting somewhere between $8.5 billion and $9.4 billion.
That is just a staggering number for an airline of this size.
It is. And the leverage ratio, which is basically debt to equity, is at 4.15.
Which is high.
Which is very high. It's not just in the danger zone. It's practically setting up camp there. If we hit a serious recession in late 2026, a 4x leverage ratio doesn't just mean lower profits. It means you might breach your debt covenants. It means you could be forced into a painful restructuring.
It removes all your room for error.
Exactly. In a capital-intensive industry that is notoriously cyclical, high leverage is just dangerous. If the economy catches a cold, a highly leveraged airline gets pneumonia.
So what's the plan? How are they tackling this? They're going on a CapEx diet? Is that the term they're using?
A spending diet. CapEx is capital expenditures. And airlines, they usually love buying shiny new planes. What they do.
Right.
JetBlue is slashing that budget to about $900 million for the year. And even more significantly, they have deferred about $3 billion in aircraft spending out to the 2030s.
But is that cutting fat or is that cutting muscle?
Yeah.
Deferring $3 billion in spending sounds responsible until your planes start looking old and tired and your maintenance costs go up because you didn't replace them.
That is the long-term risk, absolutely. But if you look at their fleet age, it is still relatively young compared to, say, United or American. They have some runway, pun intended, to pause buying new toys for a little while.
Okay.
They are prioritizing paying down the credit card rather than leasing the new sports car. At this point, it's the only responsible move they have.
They also plan to raise $500 million in 2026, it says, to handle some debt maturities that are coming due. It really sounds like they are juggling chainsaws here.
They are. But as long as they keep catching them, the show goes on. The key is to get revenue growing faster than the debt payments.
Let's just quickly look at the revenue streams again because I want to highlight how the mix is changing or how they hope it will change. Passenger travel is still the core, right?
Oh, yeah. About 84.8% of the money comes from butts and seats. That's not changing overnight. But the other segments are growing faster.
Like loyalty.
Loyalty is growing fast. It's now about 13% of total revenue, and it was up 8% year over year, even as they cut capacity. It's a very resilient, high-margin revenue. The banks buy those points, rain or shine.
And then there's travel products, which is Paisley. It's only 2.1% of revenue right now.
A tiny slice?
A very small slice.
A small slice, but you have to remember the margins. That 2.1% punches way, way above its weight in terms of its actual contribution to the bottom line, to profit. And with the United deal kicking in, you can expect that slice of the pie to get a whole lot bigger very quickly.
Okay, so they're fixing the balance sheet, or at least they're trying to. But you can't just cut your way to prosperity. You have to fly planes to the right places. This brings us to Section 4, network and fleet optimization, or what they call the shrink-to-grow strategy.
Shrink-to-grow is a classic turnaround tactic. It sounds counterintuitive, but you have to cut the unprofitable limbs to save the body.
And the first limb to get the axe was the Embraer E190 fleet.
Rest in peace, E190. They officially retired the entire fleet in September 2025.
I have to admit, I kind of like those planes. They had the 2x2 seating, no middle seats. It was a nice ride. Why did the accountants hate them so much?
Passengers liked them. Accountants, as you say, hated them. They were getting old, which means very expensive, heavy maintenance checks were coming due. But more importantly, having a separate fleet type adds massive operational complexity.
Right.
You need different pilots trained on it, different mechanics, a whole separate inventory of spare parts. By getting rid of the E190s, JetBlue becomes an all-Airbus operator. Just the A320 family and the newer A220s.
And the A220 is the replacement for the E190, right?
Yes, and it's just a vastly superior machine from an efficiency standpoint. It burns less fuel per passenger, but crucially, it has range. The E190 was a regional jet. It couldn't fly coast to coast. The A220 can. That gives them way more flexibility to deploy capacity where the money is, not just where the plane is capable of going.
So the fleet gets simpler. But the map, I mean, they took a machete to the route map.
It was a ruthless prioritization. They exited 15 so-called blue cities, places like Baltimore, Kansas City, and then internationally, Bogota, Quito, Lima, all gone.
And they reduced flying in Los Angeles significantly.
They did.
Exiting LAX. That feels like a major retreat. LAX is a huge, critical market.
It is a retreat, but it's a strategic retreat. It's waving the white flag in a battle you can't win. They looked at the numbers and said, we are the 4th or 5th largest carrier in LA. We have no pricing power. We are losing money on every single flight. Why are we here?
It's the realization that you can't be everything to everyone. You have to pick your battles.
Exactly. Instead, they are doubling down on what they call their core strongholds, the places where they are number 1 or number 2. New York, Boston, Fort Lauderdale, Orlando, and San Juan.
So if you can't win everywhere, win where you live. Build a fortress. Build a moat.
That's the strategy. Fortify the castle. For example, Fort Lauderdale is getting a dedicated Mint crew base in early 2026. They are increasing service to the Caribbean and Latin America from there. It plays right into that premium leisure demand we talked about earlier.
Except for Europe. While they are retreating from Kansas City, they are simultaneously attacking Europe. It feels contradictory.
It does, but it makes sense when you think about the halo effect. The transatlantic expansion continues. For summer 2026, they are launching 2 new routes, Boston to Milan and Boston to Barcelona.
See, that fits the premium leisure model perfectly. Milan, you think fashion, luxury, Barcelona, high-end vacations.
And high yields. These are routes where people will pay for a lie-flat Mint seat. JetBlue now serves 9 European airports from Boston alone. They're using the incredible capabilities of the A321LR and XLR. These are single-aisle planes that can cross the ocean efficiently to compete head-to-head with the legacy carriers on their most profitable turf.
But does this actually make money, or is it a bit of a vanity project? You know, look at us. We're a real airline. We fly to Europe.
It's a bit of both, and that's okay. Even if some routes are just break even, it creates a halo over the entire brand. It tells the corporate travel manager in Boston, hey, we aren't just a domestic airline that goes to Florida. We can take your executives to Milan and back.
And that helps them win the corporate contracts for the domestic flights, too.
It elevates the perception of the entire airline. It gets them on the radar for contracts they would have been excluded from before.
So on one hand, they are shrinking the unprofitable parts of the network. On the other, they are growing in very specific high-value markets.
Yeah.
It really clarifies who they are targeting.
The target is the wallet. It's as simple as that.
The target is absolutely the wallet.
Yeah.
But as with any big turnaround story, there are major headwinds. We have to talk about Section 5, the critical risks. Because it's not all blue skies, despite the name of the alliance.
No, there are definitely some storm clouds on the horizon. The biggest physical constraint they have right now is the engines, the GTF engine debacle.
Can you explain this for us? This is the Pratt Whitney thing, right?
Yes. The geared turbofan, or GTF, engines that are on their newer Airbus A320neo fleet have had major manufacturing defects. It's a very technical issue involving a contaminated powdered metal that can cause cracking in certain high-pressure turbine components.
And the result of that is?
The result is that the engines need to be taken off the wing and inspected way, way more often than originally planned.
And those inspections take a lot of time.
They take months. The backlog at the repair shops is enormous. In 2025, JetBlue averaged 9 aircraft on ground AOG sitting idle every single day because of this issue.
So that's 9 multi-million-dollar assets that they are paying for, paying leases or debt on, that are just sitting on the tarmac earning $0.
Worse than zero, because they cost money to store and maintain while they wait. This is a massive constraint on their ability to grow capacity. They have the demand, they have the routes, but they physically can't fly all the planes they own because the engines are in the shock. It's a huge drag on efficiency and their unit costs.
And then there's the competitive landscape. We touched on it earlier, the wedge.
The competitive wedge. This is the strategic squeeze they're in. The Supermajors, United, Delta, American, have gotten really, really good at cabin segmentation.
Right.
They have basic economy to fight the budget carriers on price. And they have Polaris and Delta One and flagship business to capture the super rich folks. They are effectively eating JetBlue's lunch from both sides of the menu.
And from the bottom, you still have the ULCC's Spirit Frontier. And even though they're struggling too, their very existence keeps a lid on pricing at the low end of the market.
Right. So if JetBlue tries to raise its fares too much, the most price-sensitive customer just hops over to Spirit. But if they cut their service levels to save money, the customer who values experience just goes up to Delta.
So JetBlue is trying to carve out this middle ground, a boutique experience.
Yeah.
Better than Spirit, but maybe friendlier and a bit cheaper than Delta.
It's a narrow lane to fly in. The post-pandemic revenge travel boom is fading. People have spent their excess savings. They're carrying more credit card debt. If the economy slows down, discretionary leisure travel is one of the first things to get cut from the family budget.
And JetBlue is, what, 85% leisure-focused?
Exactly. Corporate travel is stickier, but JetBlue is still fighting to get a bigger piece of that pie. If a recession hits, their core customer base stops flying, or at least flies less.
Plus, they mentioned Winter Storm Fern and some Caribbean airspace closures in early 2026 as temporary headwinds. A reminder that weather is always the wild card for an airline that's so heavily concentrated in the Northeast.
Always. A bad snowstorm at JFK can wreck the profitability for a whole week.
So let's bring it all together, the conclusion. The turnaround alpha. After looking at all of this, what's the verdict here?
I think the only fair verdict is that JetBlue is a high-risk, high-reward turnaround play. There is really no middle ground on this one.
It feels binary. It either works spectacularly or it fails spectacularly.
It does feel that way. The bull case is compelling, you have to admit. Domestic first class works. They successfully capture that premium revenue stream. Paisley scales with the United deal and becomes a high-margin cash cow. The Blue Sky Alliance fills their planes with United customers.
And in that scenario,
margins expand significantly, they pay down the debt, and the stock probably doubles or triples from here.
And the bear case?
The bear case is that the debt load is simply too high to escape. A recession hits later in 2026 before they've had time to fix the balance sheet. The GTF engine issues get even worse, grounding more planes. They can't pay down the leverage fast enough, and they just get squeezed out of existence by the Supermajor.
It's a nail-biter.
It is. But I will say, the management team is executing. Beating that 2025 EBIT target by over $100 million is a very strong signal that they aren't just hoping for the best. They're actually doing the hard work. They're making the tough choices, like leaving LAX.
And here's a final provocative thought for our listeners to chew on. Something that really struck me as I was reading about this United deal.
Let's hear it.
The Blue Sky Alliance, and specifically the Paisley component. It raises a fascinating question for the entire industry. Can an airline survive by becoming a platform? By powering United's ancillaries with Paisley, JetBlue is essentially becoming a travel tech company that happens to be attached to an airline. Is this the future for mid-sized carriers? Stop trying to just be better at flying planes and start being better at selling the technology of travel.
It's a brilliant question, because if the core business of flying the metal tube is always going to be low margin and high capital, maybe the software business is the lifeboat. It completely blurs the line between an airline and an online travel agency like Expedia.
Exactly. At some point, do you ask, are they an airline that has a good website, or are they a travel website that happens to own some planes?
We'll find out. The answer to that question could define their next decade.
We will. As the investor sentiment quote in their deck says, risk defined, portfolio protected. But for JetBlue, that portfolio is definitely going through some major renovation.
Indeed it is.
So we want to encourage you, the listener, to watch that domestic first rollout in late 2026. That is going to be the true litmus test of this whole JetForward thesis. If you start seeing those seats are full on the JFK to Nassau route, the plan is working.
And if they're empty, we'll be having a very different conversation a year from now.
Thank you for diving deep with us today. Keep your eyes on the skies and on those quarterly earnings reports. We'll catch you on the next deep dive.
Safe travels.